Welcome back, listeners. My name is Larry Kulvig, founder and CEO of the Haven Financial Group, and you're listening to the Haven Financial Group radio show, where every week we talk about retirement, all the retirement topics that are so very important. I call them the retirement puzzle pieces. Do you have all the pieces? Is your puzzle missing pieces? And are these pieces being coordinated in a way that you're maximizing the opportunities, minimizing taxes, and a variety of other things that sometimes definitely go unnoticed? And it's why we're having conversations about them, so you can get ahead of the game a little bit before you get there.
Lance Larson, a CPA at Haven Financial Group, is our guest today, and we're talking about taxes. We just talked a bit about Social Security and taxation associated with that. And obviously, Larry mentioned as we left the last segment that about 70% of Americans rely on Social Security as their main income when they're in retirement. But another, of course, source of income for retirees are their 401ks and their IRAs. So let's talk about, Lance, how those are treated when it comes to the IRS.
Yeah, Kim. So first thing to understand with 401ks, IRAs, what these things are is that they are rules that allow employers or the individual to set up a retirement account. So 401k is set up specifically for like corporates or for corporations there. Then you can have 403bs, 457bs. All these things, what they are just code sections that allow us to contribute money into a retirement account. Mm-hmm. And specifically with this retirement account is that these rules allow us to take a deduction up front for all the contributions we make into these plans. So when you look at the amount of money that's in your 401k, in the 403b, in the IRA, all these traditional ones, they are deferred, tax-deferred accounts. So when we finally take the money out, that is when we have to pay the taxes on them. Recently, they have been making a push more for a Roth account under the same code section. So you can either have the traditional where we get the deduction for it up front, or you can do it as a Roth where we don't get the deduction for it, but then we get all the growth tax-free. Mm-hmm. Now, there's caveats on each side of, hey, you got to do this, you have to wait for this period of time. So there's rules that are associated with them. But that's the biggest question I've been hearing recently is what's the difference between Roth and 401k Roth versus traditional IRA? What's all these differences there? Mm-hmm. And that's kind of where we sit at.
Sure. It seems that this is where you really need a partner making some tax decisions, how to draw this money off of these accounts and not be hit with a gigantic bill. So maybe you can walk us through how you advise some of your clients to benefit from their money, but not owe Uncle Sam such big chunks at one time.
So one of the biggest things that we look at, Kim, is how much money do we need to have, and then where do we pull things from? We've had come across lots of clients that come in there that says, hey, I need to pull out $100,000. And they just do it. They just take it out of their IRA and they're just like, hey, I'll have to pay taxes. Well, depending on how much income that you're bringing in, you can jump tax brackets. There's a big jump going from a 12% bracket to a 22% bracket. Yeah. There's another huge jump going from a 24% bracket to the 32% bracket. So do we really need to take that much money out right now? Could we possibly delay that, especially now in fourth quarter? Could you wait another 3 months until January to pull out more money and we get a fresh new start as of January 1st? So these are the questions that we kind of look at is the need versus how much taxes are going to cost you.
Mm-hmm. Then there's always the issue of required minimum distribution, which hits at a certain age, and then you do have to start drawing this money, taxes or not.
Correct. So again, as we talked about with these traditional accounts, this is all tax deferred money. And after a while, Uncle Sam has been very patient with us, waiting for us to give them their tax revenue on this income that we've earned. And so now they say, oh, you have hit a certain age, which right now is 73. We'll go up to 75 here in 2033. So there's a little bit of time until that. But you hit this required minimum distribution age, and then there's a calculation that has to be done every year based upon how old you are, the actuarial table of when the IRS thinks that you're going to leave this world, and then how much money you have in those accounts.
Mm-hmm. And that's not something that you can avoid.
Nope. The only way you will avoid that, which isn't really avoiding it, is by giving Uncle Sam at least 25% through a penalty because you did not take that,
right?
Which is an absolutely horrible thing to do. So we'd rather you take that required minimum distribution, even if you don't need it. There are other things that we can do with that, such as qualified charitable distributions. You can take that. I know Larry likes to tell the story about one client who said, "Hey, I don't need to have this money." And Larry said, "Well, why don't you take your wife on a trip?" And then 2 or 3 years later, she came back and said, "Larry, you know what? He finally took me on that trip."
It worked. I just planted the seed, Kim, and it worked 3 years later. So, hey, sometimes we can assist in a variety of different ways. But I want to point out, being we're talking on 401ks, RMDs, et cetera, we do a lot of 401k rollovers. So if you have a lot of orphan 401ks, I had somebody in this week that had literally 5 401ks, was a consultant, jumped around, or maybe you're just retired. There's a variety of reasons why you want to roll that into an IRA. There's different rules with IRAs than employer plans. You have better investment options, more options, a whole bunch of reasons on rollovers. We were talking about income distribution, taxes. They all go together. And when people retire, you just entered a different season of life. You were putting it away in the 401k. Now you have to draw money. You have to create your own paycheck. Where is it going to be drawn from? You want to look at all your options, and you want to be as tax efficient as possible. We're entering the fourth quarter this week. This is a timeline where this quarter we have a conversation with everybody about, is a Roth conversion viable? Does it make sense? For some, it doesn't, but I'd rather have it not make sense than it makes sense and then they not do anything about it.
Right.
And then maybe a draw from a non-qualified brokerage account with zero capital gains tax. Maybe that's the place to draw from. And also the timelines with RMDs. RMDs have to be the end of the year. We don't wait till the end of the year. Our deadline is December 1st. There's no guarantee that things get processed if you wait till the last second. Maybe you inherited an IRA. Maybe you lost somebody recently. Just this week, I was with a sister and a brother that one of my clients passed away, and I needed to help him with the paperwork to inherit the IRA that mom left for him. Those also have to have RMDs. So you don't want to miss these timelines. You don't want to miss these opportunities. You don't want to accrue any penalties for missing these timelines as well. That's where a partner you can lean on. That way it makes all the sense in the world. Sure,
absolutely. Yeah, you don't want to miss those because, as Lance just told us, that 25% penalty is not anything that you want to pay, and that's up and above the taxes that you're going to have to pay once you draw that money out. Let me ask you guys, we're seeing constant changes in the tax laws. IRAs, 401ks, Roths, will these be affected in the near future by any of the changes that might be on the table right now?
Not really. Okay. The code sections that are set for these retirements, I'm not a political analyst by any stretch of the imagination, but in my viewpoint, it just seems like it would be political suicide for any of these politicians to go through and try to monkey around with all these tax laws to say, oh, you can no longer do a 401k. In fact, it's actually quite the opposite of we saw in the big, beautiful bill, there's things that they're calling the Trump accounts, where for children being born right now, they're going to open up an account and the government's going to give them like $1,000 or $2,000 of money to start a retirement account for these new kids. So as far as changing the code sections for them, no, there's nothing that should happen that way. If anything that would change in the future, it's just going to be the tax rates. That's where right now we have made the 10, 12, 22% that we're used to for the past 8 years semi-permanent. But again, as soon as we get a new administration, we get the House and Senate different control in that one, they can change those tax rates and probably bring them back up to what they historically have been at that 10, 15, 25 rates.
Lance Larson is our guest. He's a CPA with Haven Financial Group. We're talking about taxes today and how they relate to retirement. If you have questions about taxes, if you have questions about retirement, these are the folks you want to speak to. All you have to do is pick up the phone, call 612-504-8400. Tell them you heard us here on the radio. You'd like to come in. As Larry has said many, many times and has repeated already this morning, the fourth quarter is a great time to sit down and do some tax planning for the next year. You don't want to just wait and then wish that you had made changes. This is the time to start planning and talking. 612-504-8400. Coming up next, how is your home sale taxed? This is the Haven Financial Group Radio Show.